Hello, YouTubers, friends, compatriots, bootlickers, shills, death slicers, peasants, vassals, minions, meat sacks. I'm Useful Idiot. Welcome. And yeah, back to the good old USA. And let's talk about oil. The drop in oil prices and this entire crash of the oil industry. And yet we have yet to see relative calamity. And what about losses at the banks? You'd think there would be more carnage out there, and there is carnage out there. It's just masked, and even in spite of the fact that there's predictions now that a third of all U.S. oil and gas producers could go bankrupt by the middle of next year. And so, why are these losses not being realized? And so, let's go into the story. But I want to preface it first, though, to say that the relative damage from the oil losses, it's relative compared to the housing crash, which was much larger. So we're not talking about the same level of carnage coming from the collapse in oil prices as we did the collapse in house prices, in spite of the fact that we have a slide that began in 2014 with $100 a barrel oil and now down to 40 and fluctuating in the 50 to 30 zone. And so anyway, we have the fact that there's going to be ripple effects through the economy. We've seen that, but we don't see much reporting on it, and that's the decimation of a lot of communities in places like North Dakota where production has really dropped. And so we see the industries and services that have been built up, including housing in all those areas, that's very depressed right now as this whole industry contracts. And then there's all the froth in the junk bond market because, of course, all these industries expanded using debt. And so at some point, somebody's going to have to pay the piper. And then we're seeing the loss of a lot of high-paying oil shale jobs. So there's also job losses along with the fact that the service and industries that grow up around those regions are failing. Lending losses on energy companies. And that's one of the things that we're interested in as far as the banking industry is these lending losses on energy companies. And we've seen a lot of collapse, certainly in the alternative energy industry. And that's an interesting story in itself because we now have oil such low prices that actually a lot of the green energies are having a hard time being economically feasible. And then there's the lending losses in the real estate booms and transportation. And that's been brought up by various economic observers. The fact that all the contraction in the real estate, well, like I say, in these communities and the infrastructure that was built up to sustain this oil boom in the United States is contracting, as well as all the transportation. That includes truck, rail, and also shipping. And all of that was also expanded using debt. So every level of the expansion in the oil industry has a level of debt, and that's another reason why we have to consider, like, where are these losses? They're going to show up. So we have Euro banks, which only have about 100 billion in energy-related losses, so they can easily absorb it. But of course, they have a number of other non-performing loans that are dragging them down. So energy losses are the least of their concerns. But there's also been losses for investors in oil and gas of $2 trillion in equities and $150 billion in bonds. So that's part of the untold story of the carnage we've seen out there. But for right now, you see these investors take the hits, $2 trillion in equities. So once again, where are the big hits for the banks? And also we have the stockpiles and oversupply continue to build, which is a cottage industry in itself and is generating actually some profits. But some areas, the rig counts have dropped by 80%, and at least a lot of the production associated as well. So that's all in contraction. So there should be a lot more big losses showing up. A good example, the Bank of International Settlement said that between 2006 and 2014, global oil and gas industry debt piled up from $1.1 trillion to $3 trillion. So we have a global oil and gas industry that's built up to $3 trillion in debt. And once again, we should be seeing more losses. A good example, of how the debt taken on by this oil industry. One company, Quicksilver Resources in Texas, filed bankruptcy with $2.4 billion in debt. That's just one company. And the creditors are going to lose $2 billion or 88%. So, and they could only generate $300 million for selling assets. And that's one of the other sides of this picture is of these companies in oil industry that contracts. Where do they sell assets? You know, the asset prices have dropped for everything too because nobody else wants that material either. So there's another layer of losses. But to take 88% losses on the collapse of just one company in Texas shows once again the extent of these losses that should be recognized. And U.S. energy and mining losses in 2015, another article pointed out, wiped out 8 years of profits, $227 billion in losses. All the profits from the last 8 years of this gigantic shale energy boom in the United States. So that's also very telling. And one thing we know, though, is that the banks have been building up what they call, anyway, building up reserves for loan losses, and that should hat tip. And even though they're only putting up, you know, 1 to 5 or 10% even, I doubt it's even 10%. It's probably between 1 and 5% reserves up to the amount of losses they could have. We can assume that if they're putting up another $10 million or $20 million or $100 million, it's really not going to add up to much considering what their real exposure is. And that's the problem. We don't really know what their total exposure is. J.P. Morgan, as far as we know from public numbers, J.P. Morgan has an exposure of $44 billion to the oil industry. Wells Fargo has a $42 billion exposure to the oil industry. Citigroup has a $58 billion exposure to the industry. Morgan Stanley, $16 billion, and Bank of America, $43 billion. So there's a couple $100 billion of exposure there, and yet we have this collapse going on, and we're still not seeing the losses show up. And then all the associated derivatives. Of course, just like the real estate crash, that's one of the things we have to worry about most is even though the sector for exposure in the oil industry is not as large as what the real estate exposure was, there's still going to be a considerable amount of derivatives associated with it. But to get to why exactly we're not seeing any losses, the only thing that seems to have shown up out there is the fact that the Dallas Fed quietly suspends energy mark-to-market. And I've discussed this before, the whole idea that there's a lot of fraud still perpetrated out there because they suspended mark-to-market rules for banks when the economic collapse happened in 2008. And that's the idea that when you have taken losses, you mark down the value of those assets and put them on your books as losses. But if you suspend mark-to-market, then you don't really have to even report your losses, and you still consider all these liabilities as assets. So anyway, in this article, they pointed out that they suspended mark-to-market on energy debts, and no impairments are being written down. I don't know any other way to interpret that other than the fact that they're basically just telling the banks that you don't have to write down any of your losses in the oil sector right now, and that probably everybody is betting on some kind of recovery in oil prices, and therefore they won't have to realize these losses. And this is a pattern we've seen from the banks before. Not only do we not know what their actual exposure is, but the fact is when the shit hits the fan, we're going to find out that their exposure was a lot more than we thought it was, and it will happen probably all of a sudden. The article goes on to say the Fed indicated under the table that banks were to work with the energy companies on delivering without a markdown on worries that a backstop was needed after reviewing loan losses which would exceed the current Tier 1 capital tranches. So in other words, they're giving them a free pass, and nobody really needs to worry about it for right now. The banks and the oil industry are in collusion to sustain the fallacy and the mythology that these losses in the oil industry haven't happened, and if they wait long enough, they won't happen. And oddly enough, what they're suggesting is not forcing bankruptcies and demanding asset sales, which is hilarious. As I pointed out, who are they going to sell these assets to? So they're going to try and absorb the losses in the oil industry and the bank's exposure by asset sales, trying to sell shit that nobody wants anymore because the whole industry is in contraction. So there it is. It's not a big story, but it's interesting nonetheless to see why we haven't seen this carnage at the banks with all these losses in the oil industry, because as we know, the oil industry touches so many sectors. There has to be massive exposure, particularly when this entire energy oil boom in the United States has all been paid for with debt. So at some point, this is going to be a big story. But I'm going to make the video now, and then maybe somebody will watch it 2 years from now when all this shit hits the fan. I'm a useful idiot. Don't you be one too?